Germany is spending €500 billion to kickstart its economy. Austria is fighting rising unemployment and energy prices. And Switzerland? Switzerland is doing what it always does, staying calm and weathering the storm. This is your DACH economic briefing for July 2026. Germany's economy has had a rough few years. After a recession in 2023 and 2024, the government modified its constitutional debt brake in early 2026, unlocking a €500 billion special fund, known as the Sondervermögen, for defense and infrastructure. The result? GDP growth is expected to reach between 0.6 and 0.9% in 2026, the first domestically driven recovery since reunification. It's not a boom. But it's the beginning of a turnaround. Germany isn't out of the woods yet. Inflation stood at 2.7% in May 2026, above the ECB's 2% target. US tariffs and uncertainty around trade policy continue to dampen export performance. Germany's export-driven economy is especially vulnerable to trade disruption. But government spending is stepping in where exports have weakened, a fundamental shift in how the German economy is being run. This analysis is brought to you by Yellowstone Finance Group, a performance-focused CFD trading platform built for active traders. Trade Forex, metals, global indices, commodities, shares, and crypto, over 10,000 instruments, all from a single account, with ECN pricing from more than 25 Tier 1 liquidity providers and execution averaging just 40 milliseconds. Tighter spreads. Faster execution. More markets. Explore the platform at yellowstone-financial.com. Austria is having a harder time. The country was hit by an energy price shock from spring 2026 onwards, linked to the Iran conflict driving up oil and gas prices globally. Economic growth is projected at just 0.8% in 2026, with a slight improvement to 1.2% in 2027. Unemployment has climbed to 7.6%, one of the higher rates in the German-speaking world. And inflation, though forecast lower at 3.2%, remains above the European average. Then there's Switzerland. While its neighbors deal with energy shocks and sluggish growth, Switzerland is managing well, if cautiously. GDP is expected to grow 0.9% in 2026, below the historical average, but stable. Inflation sits at just 0.9%, and unemployment at 5%. Switzerland's economic independence from the EU, its strong franc, and its diversified export base are acting as natural shields against the regional pressures. The risks are there, but they're manageable. The DACH region enters the second half of 2026 in a complex position. Germany is slowly recovering, but the recovery depends on government spending holding up while exports stay fragile. Austria is dealing with the most acute short-term pressures from energy costs and unemployment. Switzerland continues to outperform on inflation and stability. For traders watching these markets, the stories moving prices right now are oil prices, the UniCredit Commerzbank deal, ECB rate signals, and German GDP data. These are the catalysts that drive Forex pairs, commodity CFDs, and European equity indices. The kind of markets Yellowstone gives you direct access to. 3 countries, 3 stories, and all of them create real opportunities for traders who know where to look. At Yellowstone Finance Group, you can trade the Forex pairs, commodity CFDs, and European indices that move with exactly these kinds of economic shifts, with ECN pricing, fast execution, and over 10,000 instruments from a single account. Visit yellowstone-financial.com to explore the platform. Subscribe to this channel for weekly DACH economic analysis, and drop a comment. Which economy do you think will surprise us most by year end?